So welcome once again. This is our weekly review on markets on October 31st. So I think this has been a very interesting week. As we were talking before we started recording, that this was a big week, and this we got like a lot of earning reports. We had the Fed meeting, which actually, even though it was not a big news from a perspective of the rate cuts, which was like Powell has never surprised. We were expecting 25 basis point. That happened. QT was also kind of hinted already in the previous speech by Fed. So what happened is that when they announced that the QT is ending, that was also not as big a news. On the other hand, we will look through some of the updates that now what changed was the kind of hawkish stance on the next rate cut, which did not go well with the market to a certain extent. But I think ultimately there are bigger things at play, which we will show you. So let's quickly jump into the market first, then I'll talk about macro, and then we can go from there. So let's look at where we are right now on SPX. And as we see, this is more or less, I would say, we are still at the top. As we discussed last time when the another tariff were announced, we were discussing how this tanked the market, but it very quickly recovered, which has been the case every time we have seen these kind of sharp corrections, which happened in earlier in the October. But now I think the major issue, what is happening here is the FOMC meeting. Even though not it was a positive news for the market, especially around QT. I think the rate cuts were already priced in, but the QT date, we got on December 1st as the date when the QT completely ends. But on the other hand, let me focus on what was the negative which came out is the hawkish stance on the next month, basically the December meeting. And if you see, we used to have a 90% plus chance for another rate cut. Now that has slipped to 70% today after the Fed meeting. So this is where I think market is kind of questioning now, in the sense that whether there will be another rate cut. And another reason being, as we always say, that rate cuts are not happening in isolation. There's the whole system behind it. And one of the things which I think a lot of people are observing right now is the bank lending rates. So as many of you may know, there's something called SOFR, which is the interbank financing rate, overnight financing rate, and that has been going up. So it doesn't even matter if the Fed cuts the rate, the actual financing rates are tracking higher. So almost the rate cut has been canceled out by the markets. And the reason being the liquidity is drying up in the market. So what it means is rate cuts are less important to the market right now. What is happening is the cash is not available. Banks are struggling to find funding. And that is becoming the theme here. So liquidity is drying up. That's a sign very clearly visible. If you see for like last 3 years, there is never a case when SOFR is higher than the overnight rates, which are it's always in negative, and now we are seeing the spread becoming bigger and bigger. So I think this is what is kind of troubling the market a little bit, which we are seeing as one of the concerns. And this is where I think market is trying to figure out that without any major changes on the liquidity situations, even if you cut the Fed rate, how would SOFR come down? How would the real rates which banks lend to each other will come down if there is no cash? Because you will basically put the spread will become bigger and bigger. So this is where I think currently the concern in the market is. And one of the reasons why that is happening is, as you all know, that at one point we discussed that there is no real impact of the shutdown. But on the other hand, the way the shutdown is happening, even though and this is a little bit political. I don't want to go and get into the politics of it, but if you see that recently the Trump administration has decided not to even release some of the payments which they can release. So overall, what it means is that the TGA balance is continuously growing. Now it has grown to almost $1 trillion, almost, and that is where I think imagine all this liquidity which is getting sucked out of the market. It is sitting in Treasury General account, which is not available for banks. And this is one of the reasons why you're seeing this pressure on the bank lending rates. So overall, macro is changing. Macro is changing from excess cash to lack of cash. And that is what is, I think, troubling the market somewhat. On the other hand, as we see, there's no major pressure on the markets because they are driven by this so-called tech companies and the top AI boom. So from that perspective, yes, we haven't seen many major corrections. but we are seeing general stress in the market that liquidity is drying up. We saw that in the correction in gold. We saw that in the correction in Bitcoin. All the typical representative assets, which are usually tracking the cash in the market, they are struggling mainly because of these reasons. So gold rally was cut short in last few days. It has corrected. We have seen similar things with silver, which is usually tracks the gold, even though silver is actually kind of bottoming out before technically, and we are seeing some money flowing now because there is underlying demand for both of these assets. But in general, I would say that we are seeing the pressure, and same thing is happening now. You will see that there is bond yields are going up. You are seeing a lot more of kind of assets. All the assets are struggling a little bit. Now, when coming back to the SPX, what really happened is everything is now driven by the news on the stock specific. It was a big news week. We saw a lot of earnings. We saw how Meta crashed because of the negative feeling around the spending. Because as we all know, while most of these other players, like whether it is Microsoft, Google, and Amazon, which is like some of the big spenders, they are spending because they have a direct revenue impact, because they are selling the cloud services. Meta does not have something like that. So it got hurt when they did not show any slowdown in spending, even though their earnings are great. Like if you look at their core business, that was really great. They showed acceleration in their revenues and their profitability. On the other hand, market is now starting to question, when will you show me the impact of AI spending? Like, why are you spending when you are not even reselling? So these are individual news stories. I think people are tracking. Same thing happened on the other end. We saw the Google of the world and Amazon of the world did very positively after earning because of the AI impact. Of course, they showed the strength, and I think Microsoft was kind of a reaction, which is more about. I would say it's very interesting that while Meta got hit because they are increasing the spend, Microsoft probably got hit. The story is that they're not spending enough because they are actually gaining because of AI and they're not spending enough. But anyway, I think, as I said, we are not going to go into stock specific detail, but overall, what the storyline is right now, that we have hit a situation where the macro is a little bit tight from the cash flow perspective, which of course can change very fast. As you know, that this is a short-term issue. When we are talking about the liquidity in the system is not systematic in nature. Systematically, we still have a lot of cash in the system. Right now, TGA is absorbing a lot of cash out, and there is banks have low reserves. This can change very fast as soon as this issue is resolved. But in fact, even if the government shutdown is not resolved overnight, they can start releasing some of these payments, which are only the discretionary one they cannot pay. All the non-discretionary they can still pay right now. So I think those things can change, but at a macro level. But in terms of stocks level, I would say it's more about how the market is reacting to the earning, because everything is overvalued, everything is over leveraged. As we discussed last couple of weeks, that market is heavily leveraged. So the reactions are bigger and the volatility is expected to be bigger. On the other hand, at a net SPX level, volatility has come down since last week. But I think stock specific volatility is earnings driven, which probably will settle down after the earnings are over. So that's where we are, I would say. And also remember that when we talk about bank liquidity issues, typically those are worse around month end. Now that we are end of October, so we will see a little more, positive fund flow probably from November. So overall, yes, there is a change in macro. Yes, there has been change in, as we discussed, the rate cut probability is reduced. The banks are struggling for cash in terms of the funding rates, and TGA balance is growing, which needs to start flowing back. All this money has to start flowing back into the economy. And this is not a small amount. We're talking about almost $1 trillion sitting in the TGA, which is, I think, we have to watch out how this plays out. But remember one thing, we talked about it in Investor Day. As soon as the TGA starts spending, this is way faster than any QE, because this goes directly into the bank accounts. It goes directly into the payment overnight. And that liquidity floods into the market, situation rebalances very fast. So the impact of Fed doing a repo or Fed doing QE or QT is a slow move, while the impact of TGA absorbing cash and releasing is much faster into the system. So it can change overnight. So I would say this is not something you can trade on. You can say that, oh, wow, that now that the cash is low in the system, that market will crash. It need not happen. I'm just highlighting what is really happening in the market right now. So other thing is, as we know, Fed has been already helping by in the COVID time when they created a lot of cash. This is the overnight repo which Fed is absorbing from the banks. This was designed for reducing liquidity in the market. In 2023, it used to be in multiple trillions of dollars. Right now, it's almost at zero. So this is good news that Fed is no longer pulling liquidity out of the market, and they are at the end of their rope, right? They are not able to do anything as long as they don't stop the QT, which they are doing. So the best they could do was stop QT, which they did. So not only they have been stopping this pull from the market, they are also releasing another few $1 billion which were happening in QT. So from December we will see little more, you can call it improvement in liquidity. And I think now the market is wondering, are we ready for QE? Because if this situation persists, we will see continuous issues at the business levels. We will see the same issues which we are already seeing in unemployment numbers and so on. And I think that's where the deal is. So overall, what is driving the market is still the same. I think the biggest news story after earnings cycle always is CapEx. Is AI story still intact? Are we seeing a lot more of AI spending? And that was reconfirmed. As we can see, the capital expenditure is still growing at a very fast pace. Whether it is Meta, Google, Amazon, or Microsoft, these are the four big spenders. Now you're looking at hundreds of billions of dollars every quarter. Now we are talking about almost $500 billion. This is what happened with even though there was no earning, and we had this great big announcements from Jensen in the GTC and so on. And more importantly, like companies like Nvidia, companies like which are in AI play are getting re-rated again, because the whole theory that AI spending is over is not really materializing. AI is continuously growing. The capital expenditure is still growing. And now you're seeing more and more analysts coming out and justifying that the same thing which we have been talking about for a long time, that this story is not over yet. So I would say this is, we have discussed enough. I think if you came to our investor day, we did talk about why AI story is still in early days or still in the middle of, this whole spending cycle. I think market is now realizing that. So you will see this or all this whole cycle is being represented by the ups and downs of expectations in whether we have hit the top, whether we are going to continue to see expansion. And what happened this earning cycle was also, I would say, Google of the world and some of these actual monetization. If you say Google used the word accelerated a lot in their earnings, and I think analysts caught up to that. Right, it was a great story where they said that that everything accelerated, and they are saying that our investments in AI are now materializing. We are seeing cloud growing at much faster rate. They are seeing all the other segments seeing some benefits relatively. So I think that's what people are now kind of becoming believers that we are still, the monetization is starting, monetization is increasing. So it is justified. On the other hand, people are also questioning somebody like Meta, which cannot show correlation directly between spending and their platform because they are not the cloud player. So this is, I would say, the summary of the market right now, where there are winners and losers. There are people are picking stocks based on what they believe are going to be the AI winners, whether they are justified in spending, whoever is spending. And I think that's going to be a stock picker market in near future, while we are struggling for macro level volatility, macro level lack of liquidity. And as soon as, I would say, this whole liquidity situation improves, because there is cash in the system, it's a matter of where the cash is parked right now, whether it is sitting in TGA doing nothing, or whether it's released into the markets and we start seeing a lot more of cash sloshing around in the system. That will define the bigger picture moves, while I think market is currently rotating into stocks based on their earnings and so on. So that is a summary. Anything, I will let people ask question right now. You can unmute or you can put your comments in the chat box. But would love to understand where people are, what their views are on after earnings, what you guys are feeling about the markets. But overall, as always say, the medium to long-term picture of macro is still the same. Nothing has changed. The same AI story, the same. I would say there is still a lot of cash in the system. Short term, both of them have hit a hiccup. We have seen that earnings are behind us, so most of the usual expectation of a big move, which is already behind us on many stocks, and some of them actually disappointed with their earnings. But now the short-term macro is definitely struggling, and first time I would say because there was no concern in the shutdown for a few days or a few weeks, but now that the TGA is kind of absorbing more and more liquidity, now we are clearly seeing a sign of correlation of shutdown onto the markets, where the banks are struggling for the reserves, and more and more cash is getting parked in TGA. So I would say that is definitely impacting the market, and we may see more of this if the money is not coming back into the system in short term.
So Raman, the
So
money is sitting on TGA because people are not getting paid due to shutdown?
yes. So what happens is the TGA is basically your checking account of the government. So what happens is as you are reissuing the debt, all this money keeps on coming in, and usually government is spending weekly, monthly payments. And as you are right that as they are not getting paid, all that money is continuously locked into the system. So what happens is when people get paid from TGA, that goes into private accounts, either in company accounts or personal accounts. That is all bank balances. Those bank balances are available for banks to go loan. TGA is a locked up system where there is a treasury general account sitting in, hold in the Fed with a certain amount, and that cannot be accessed by banks. That is capital. Basically, it's almost acts like a QT, where all the money which is going out of the system is not available for the rest of the market, which is not available to be rehypothecated, not available as a collateral, and so on. So yes, so that is a concern. If you remember, we did discuss this few weeks back. We were not expecting this to be a problem because neither we were expecting the shutdown to go on for such a long time. Short term, it doesn't create any problems. Secondly, there is a lot of provisions in the how it works is that you can still pay the non-discretionary payments, the mandatory payments. But what happened in last 1 week or two to resolve this issue, Trump administration has started putting pressure on Democrats by actually cutting even those payments which they can make. So this is more of a political pull and push. Let's see where it goes. I don't think this will last long. Probably, if they are not able to achieve anything with this with Democrats, they might actually end up releasing next week some of these payments. So, but overall, yes, there is definitely a directional stress in the system when you look at the TGA balance rising every week. By the way, these are released every Wednesday, so we will only know the update next week by Wednesday whether they are still releasing payments or not. But yes, the situation here is that shutdown continuing longer at some point is going to hit the system because this is direct liquidity being absorbed out of the banks. And if you look at overall situation in macro, we all know that the macro headwinds on the unemployment. This is why Fed is cutting rates. This is why bank lending rates are increasing overnight. There is stress in the system, and the QT ending on December 1st, which is what Fed has announced, is in direct response to that. So there's a lot of things which are being handled already. Like QT was a big problem because if you have already low liquidity situation and the QT was continuing, that was not great for the system either. Now you have TGA acting like QT, which is basically pulling the liquidity out of the system. So, and as I said, all these things can be resolved very fast because TGA can solve the problem overnight. It doesn't take much time to just make the payments and everything goes back to the banks, and all this get resolved very fast. So it's not something you can rely on to take action that yes, markets will go down. But what I'm saying is this is more of a signature of what is really happening right now. And I think bigger impact of these things definitely happen on things like gold and Bitcoin and so on. All these have less news dependency and more cash flow available dependencies. So I think that's where we are seeing some of these assets struggling more. But also I think stock markets are purely paper money. They are less of a store of value. So I think you will probably not see that as a direct impact on some of the other assets like stocks, because they are purely based on trading volumes and the news. They get impacted more by the news. But yes, there is definitely a headwind, we can say, in short term.
So, by the way, Jensen was in speaking in Korea last night. He went to Korea. So
Mhm.
Korea, the Samsung, Hyundai, SK, Hynix, Korea government, and all these bought like 250,000 GPUs in
Yes,
last 2 3 years, and they are buying another 260,000 in next 3 years or something. So there is a lot
yeah,
of buying going on outside US too.
that's right. So I think overall, what we are seeing right now is, as I said, it's a pure AI-driven market. And secondly, we are the only thing which people are not sure about is that in what inning we are in from the AI spending perspective. Some people believed earlier this year that we are probably in the ninth inning of the AI spending. While as if you attended our investor day, we were talking about why we are still probably in the middle of this whole thing, and probably in the fourth inning or so. So what we are seeing is more and more belief in the market now. This is what happened in last couple of weeks. If you see last week, especially the Nvidia got re-rated, it jumped up to all-time highs again. Um, it was purely because the people starting to realize that the same fact that AI spending is nowhere close to ending. So whether you talk about tech companies in US or whether you talk about the sovereign investments, like there is going to be a question mark because now we are also going into deglobalization. We are seeing that in modern days, people are want to be less dependent on US. And as we always discuss that most of the tech or AI spending, especially the data centers, are coming up in US. So Jensen is smart about it. He's going around different countries, and for him, it doesn't matter. He just wants to sell his chips. So he has been pitching, whether it is UAE or Saudi Arabia or whether it is Korea and Japan. He's suggesting that everybody should have their own data centers. They should have their own, the data should stay in their countries. So I think that's a good pitch for NVIDIA. I think it's great result for most of the hardware players. The question mark is whether AI will evolve like the cloud companies, like where Google of the world and Facebook of the world were controlling the social media and the search, and it was a kind of a winner take all market, or whether these individual local markets can be developed. So that's for future. But at this moment, definitely it's a positive for somebody like NVIDIA or even all the other hardware players, because this is being seen as an AI arm race right now. Like everybody is worried that you basically AI is promising not only just the what we are seeing in software. Right now, we are talking about robotics. When you're talking about even the whole wars are being fought with drones nowadays. We have seen it in recent wars. We have seen it in Russia-Ukraine war. We are talking about, like Palantir is talking about converting everything using a AI framework, using all the wars will be fought like that. So it's becoming a national security thing for everybody. Even the data is national security thing because everything runs on your cloud, and people are struggling with the fact that in a deglobalized world, as people are becoming more and more polar like we are seeing multipolar world emerging now. People are worried about depending on only US tech, which is in a way that is going to create a tailwind for the AI hardware players like NVIDIA's of the world. That now people are not just saying, okay, there is enough Amazon or cloud or Google Cloud services. I don't need to spend my own. So I would say it's opportunistic for NVIDIA and it is working for them right now. But again, the question people are going to continue asking is what is what is the real spending power? Because if you see, there is another question mark, which is till now we were discussing that mostly it was the cash flow of these companies, even in tech world, or most of the excess cash was being used, which is now we are hitting a domain where more spending is done through debt. So there was a great analysis I was reading yesterday that if you see now the amount of bonds being issued by these tech players, even within US, is increasing very fast this year. And most of the cash flow has been utilized now, and now the spending is increasing. They're issuing more and more debt to spend onto AI. Till now, it was, I would say, it was justified because you're basically spending from your cash flow for future. Now you're talking about taking loans. Now, any failure of AI, like let's say if now the impact of something like a DeepSeek or something like a somebody telling that, oh, AI has that the scaling cannot be done beyond a point, those news will have a much bigger impact now, because people are now going to be worried about what if this bubble burst because of there's a lot of debt now in the system which is funding this spending. So the risks of AI as while the market is enjoying this right now, the risks are increasing now. So at some point, this will be a bubble. I mean, some point people will. It's always happened, right? Means we saw it in dot-com boom. We saw it in this whole real estate boom of 2007, 2008. We have seen all these things over and over again. Markets always overshoot. Um, the only unknown is whether we have overshot already or we will be overshooting in next 2, 3 years, and that's why nobody knows the top. Everybody, but there's always a top. There's always going to be an overspending, and there will be a bubble bust at some point. So this is where I think now the smart money is discussing. So as of now, what we saw in last few weeks is, oh, we are still not in a bubble. Earning is just starting to grow, and AI is really showing promise. That's the story right now. This is why markets are again making new highs. But this story can change if you take another 10% move up or another big hype and suddenly some negative news comes. So that risk is increasing. But for now, AI arms race is still on. Everybody wants to spend and build the biggest moat in terms of what processing power they have. So this is what is driving today's market. And this is also, we discussed earlier, right? I mean, this is exactly what is hurting something like Meta. While everybody else is enjoying, like Nvidia is enjoying the benefits of all this spending, Meta is being questioned. They're saying, like, you are not reselling these services. How are you going to show the revenues? So markets punish them for increasing spending. So now we are going to see more and more of these questions being asked because the scale of spending is increasing, because the scale of now we are talking about debt-based investing into AI and not cash flow based. So things are changing at somewhat in AI trade, but underlying story is still the same, that AI is here. Monetization is happening, even though it's not as fast as the spending, but the promise of AI is driving the market right now. So yeah, I think this is interesting times, I would say. To be frank, this is where I think it will become more and more stock pickers market in near future. Um, Volatility was expected to increase because of multiple reasons, right? One is, of course, earnings always bring news, but also we did talk about, if you were in the in the WhatsApp group or in our other discussions, we were talking about how the leverage is increasing in the system, how margins are high, and then when you're talking about a macro issues around not having the right liquidity, this creates stress, further stress in the market. So I think there are multiple factors at play. So always be prepared in short term of where we go. But I think in long run, the biggest part here is that long run story of AI and long run story of we still have a lot of cash in the system. Um, that is not going to change. So if we are talking about TGA hoarding 1 trillion, as soon as the lockdown is removed and all this money comes back flooding into the market, that's a tailwind. As of today, it is a headwind because that money is being sucked out of the market. So these are things which will change in a very short notice. There are going to be ups and downs in the market based on day-to-day news, and this is where I think we always talk about, make a plan for market can move in either direction. You cannot be sure about anything. Like if you look at Meta's earnings or if you look at some of these Microsoft earnings, there was nothing wrong in the underlying business. That it's actually booming, but the market can react differently because based on the leverage, based on what market had already priced in, which is never obvious. So that's where I think we always talk about um, being prepared for either direction, having a longer term view and not trading the market on a day-to-day news basis. So these are the two things we always talk about, and I would say that is still valid today in current market. All right. So I think, as I mentioned, I think earlier we had talked about, we will probably try to close the call early. So if we can take a one or two quick questions, if anybody has. And I think everybody is preparing for Halloween today. It's a evening, so would let people go early.
Hey, Raman, quick one, like a rundown on what you thought about Meta. I know they had a one-time charge that reduced their earnings, but what did you think about Meta drop today, this week, and outlook kind of on that?
Yeah, I think nothing new than what I've already just said a few times already in this call. Like Meta earnings were great. One-time charge, I think that's nobody's paying attention that much. Of course, it did hurt their EPS in short term. Usually, market doesn't react to those. I think the bigger story was that they are that is Meta is very unique. that they are not Amazon, Microsoft, or Google. They are not cloud players. They are not reselling the data center services, and they have shown a huge increase in expense. They are borrowing from the market to keep spending on their data centers, and market is questioning what is the link between your earnings and the spending. We all know that Meta is a very strong player. They have the greatest distribution of the world. As we discussed, right, they have multi-billion users every day or every week coming to their apps. They just have to show. And also, I think Mark Zuckerberg has this whole history of spending a lot of money on Oculus, and it's just a reputation issue. Also, people are not very comfortable with his spending habits. So I think this was a kind of a reaction to that. So it's very difficult to say where it will go from here. But my reaction to that is it's mostly a matter of how people are justifying AI spending for somebody like Microsoft and Google versus Meta, which is not a cloud player, and they need to fix their story very fast. They cannot keep on spending in hundreds of billions of dollars without showing a direct correlation on how they're going to make money on this. But yeah, underlying business was very, very strong, right? I mean, we know that they have been doing very good. So that earnings are great, but I think market got spooked by that it's not ending. Like the spending is not ending at all. And like unlike other people, like Google has started showing the returns of their investment. Microsoft has been showing return on their investment on AI. Meta is not showing that. Meta is just calling it as a investment into future without a clear path.
Gotcha. All right. Thanks, Raman.
All right, so I'll take another question on BTC here. So I think I did mention there. So BTC has a few things going on. If you go back to a few weeks earlier when I talked about how the whole tailwind of something like MicroStrategy and all these digital asset treasury companies, which were bringing in a lot of Wall Street capital into Bitcoin, that has kind of slowed down because that tap was, you can call it as a completely dried out after a huge amount of liquidity push. So that was one of the reasons when we stagnated. And in recent times, I would say it's more of a matter of very much a macro-driven problem where we have a sort of lack of liquidity in the market, which can change overnight. And if you see, the same thing happened with gold in last few weeks. Since a couple of weeks has been a little bit of a struggle now again, because the liquidity is definitely hurting. So that was the analysis which we already had an earlier part of this call. That again, it's very difficult. These are all macro-based discussions. Sometimes they do not correlate day to day. They are not going to make much sense in short term. But that is one reason I can say. But also, I think in general, it's very clear that there is very limited available cash. And $1 trillion is not small amount. When you look at the TGA absorbing $1 trillion almost, it's not a small amount when you take out of the system. So I would love to see how Bitcoin and gold do once the TGA starts draining, once the shutdown is over. But I think till then, I still believe that one of the big factor of that is that right now that there is definitely a problem in the cash market. And I think, let me see some of the comments around this. So when the mass dollar printing began in 2026 and the interest rate continued to go down, do you see any value in investing into precious metal? I would say precious metals are usually a great proxy for any kind of money printing, I would say, because what happens is, of course, the risk assets sometimes rally more, but in long run, gold has absorbed a lot of liquidity which is created. One thing you need to understand is once you print money, you cannot take it back. Like the cash always remains in the system. You can slow it down, you can make it costly to borrow, but you cannot take the money out of the system once you build it. That destroying money from the system is very difficult. You need to go through recession, and nobody has political will to let a country suffer through recession in modern days. Especially since 2008, we have found these whole tools to go and always fix things and start another QE if needed. So in short, I think the question here is about precious metal. I would say there was a lot of paper money. There were a lot of manipulations at the big banks, which was holding back. And what we saw in last couple of years is that once it breaks through, once people start moving physical gold, when people start asking for physical gold and physical silver, that easily can be broken through. And that's what happened. gold and silver were artificially suppressed, and when people started moving gold and silver around and demanding physical deliveries, suddenly the price discovery started happening. So fundamentally, it was always gold and silver kind of precious metals always have been a great proxy for inflation. Paper gold and paper gold was probably keeping it suppressed, which got resolved by as soon as people started moving out. And I would give a lot of credit to the tariffs, because if you remember, the first time the physical gold was brought in from Europe, from London to New York and so on, that actually was a big trigger on the gold rally, because once you start unrolling all the paper gold into physical gold and you start moving that, that's where you cannot manipulate things anymore. And I think that's where a bigger part of the rally materialized after that. So a lot of factors are at the play here. But overall, I would say when the money printing starts, or when the because now we are at the end of QT, there will be at some stage justification for QE. Already the rates are going lower. So I think it does benefit hard metals. It does help gold, silver. It does help Bitcoin. So macro push, I would say, is in favor of it. But when you say, do you see value in investing? Investing is a personal choice. I would say gold, silver are more and more steady state accruer of store of value, while when the money is enough, or there is a lot of liquidity in the system, risk assets will do better. Probably stock market will do better. Probably Bitcoin will do better. A lot of other higher velocity investments will do better. So I do not want to comment whether it's a good idea, but I would say definitely not a bad idea. Gold and silver will always represent store of value in proportion to the money printing. But whether they will outperform in short term or medium term, that depends on many other factors, and it's tough to say whether it's the right choice. So it's more of an allocation issue now. You should look at allocating certain portion into every kind of asset class based on your conviction level, rather than choosing between the two, because everything has its own place in your portfolio. That's how I would put it this way. All right, guys, I think I'll just close it here. It's Halloween day. I want, and everybody is preparing stuff. So I would also say that this was a great week to show that you should be prepared on both sides. You should be looking at, because especially in those stock specific moves, I would say look at your portfolio, ask yourself questions whether having this business conviction is enough, or you want to protect yourself against these big 10% moves in a single stock. So do talk to us if you need to. I think if you're part of our managed portfolios, we are already doing hedging a lot, and we are also launching these embark products, which is getting a lot of demand because people are, especially in the Mag 7 or Mag 8, as we call it now, if you are holding a lot of that stock, it's very difficult to manage risk sometimes. So do discuss with us if you need any help on that, because we have all these products, whether it's Embark or Managed Portfolio, where we are already helping people. So reach out to us, I think, in our team, and have a great weekend and happy Halloween. Thank you. Bye-bye.